Good afternoon, ladies and gentlemen. I am Therese Kettle, Senior Vice President Investment Banking at Barita Investments Limited. I'm your co-host today alongside Mr. Ramon Small Ferguson, CEO, Barita Investments Limited. We're here today to share with you key insights about the NCB Financial Group APO.
On behalf of the NCB Financial Group, I am happy to welcome you guys to this forum. At Barita, we have the distinct pleasure of being selling agents for this landmark offer for the NCB Financial Group. So, if after this forum you have any questions whatsoever, you can feel free to reach out to a Barita advisor who will be able to clarify and get you started as it relates to this offer.
Today we have with us Mr. Robert Almeida, Group CEO, NCB Financial Group. We also have Mr. Malcolm Sadler, Group Chief Financial Officer. And we have with us, joining us here today, Mr. Bruce Boyne, CEO, NCB Jamaica Limited.
So our objective for this forum is to allow the NCB team to deliver to you firsthand some key information about the offer. Right? We're not going to make any assumptions. We're going to start with giving you some insights into who the NCB Financial Group is. We're going to talk about the financial performance of the entity up to this point and maybe give some insights into how things are expected to evolve in future periods. And finally, we have to give you information about the offer itself, right? So stay tuned for what we have in store.
So we're asking you to please feel free to ask any questions that you may have on the offer. At Barita Investments Limited, we pride ourselves on making sure that our clients and the general public is educated about investing. This is our safe space here today for you to learn as much as possible about the NCB Group APO, ask any questions, learn about investing, and widen your knowledge on investing in general. So I'll now hand over to Robert, who will walk us through the presentation that he has prepared to share with you about the offer. Robert? Yes, you can.
Okay, thank you very much, Therese and Ramon, for having us. Really appreciate the opportunity and your support in this, in helping us with this APO as well, and bring this exciting opportunity to investors. I'm going to talk to you a little bit today. I'd like you to, as I tell you a story about NCB Financial Group, really like you to try and keep in mind, we're going to try and leave you with three messages today. The first is that NCB Financial Group is a great investment. It's a great business, and what makes a great investment is something that can preserve your capital, and it's a great way to participate in growth. So it's a great investment for capital preservation and growth. The second is NCB Financial Group is probably the best way to participate in and to own a piece of Jamaica and the broader Caribbean. And the third is that this is an ideally opportune time to actually become or increase your ownership of NCB Financial Group. So those are the three things. It's a great investment. It's a great way, probably the best way to participate and own a piece of the region, of Jamaica and of the region. And thirdly, now is the best time, is a great time to buy. So with that said, and we start off with a quote from our chairman, Mr. Michael Lee Chin. NCB is the people's bank. Therefore, the people should own the bank. There's a saying, if you buy the milk, you should own the cow. I call on all Jamaicans to participate in our APO. End of quote. The Honorable Michael Lee Chin, OJ. So let me start with item number one that I had talked to you about, which is NCB is a great investment. What's the purpose of investing? Why do we invest in the first place? We invest to create wealth. And then what's the purpose of the wealth? It helps us provide security, financial security. It pays for shelter, it pays for food, it pays for school fees, it pays for a number of those types of things. It also helps us to have an enjoyable and a quality lifestyle. And lastly, it gives us the opportunity to leave a legacy, to leave the world a better place than we found it. So with that said, how do we create wealth? You can look throughout history, you can look at all the wealthiest people in the world, think about the wealthiest person you can think of, And when you think of that person and you think about how did they create their wealth, they all created it through the ownership of quality businesses. So if wealth is created through the ownership of quality businesses, the very next question is, what makes for a quality business? When I first started in investing, I was asked the question, and I'd ask you to think about this question. If a wealthy benefactor came to you and said, I'll give you as much money as you want, any amount of money, 1, 2, 3 trillion US dollars or more. So you could buy any company in the world you want in its entirety. But here are the conditions. The conditions are you have to invest all of the money. You can't keep any of the money for anything other than investing it. Number 2, you have to invest the money in only 3 businesses. So you can't invest in hundreds of businesses. You can only invest in 3. And lastly, you can't sell the business for 20 years. And the question to me was, what 3 businesses would you invest in and why? So I thought about it for less than a minute, very quickly, because what very quickly came to my mind is I had to choose businesses. I was long-term investing. The first thing I had to do was I had to figure out businesses that were in industries that are likely to be around 20 years from now. They stand the test of time. They're low obsolescence industries. They've been around for a long time, and they're likely to be around for a long time. They're necessary for life in the world to keep going on. Second thing is I want to invest in a business that is central, integral to that industry, and that has a moat around it, that is defensible, it has competitive advantages. So that narrowed down the list very, very quickly, and I identified a couple of, the 3 companies. So if you distill those criteria that I talked to you about, they're the attributes of capital preservation and enduring growth, something that'll be around 20 years from now, will be worth more 20 years from now, and is going to pay me some income along the way so that I can survive for the next 20 years. So what I'm going to try and tell you about is just some attributes of NCB, and I'll do this relatively quickly. It'll be a lot of information, but they're really just trying to tell you 2 things. NCB has the attributes of capital preservation, and NCB has the attributes and is poised for growth. So capital preservation. NCB has unrivaled scale, $2.2 trillion of assets, larger than the next 8 companies in Jamaica combined. Not only is NCB big in absolute terms, on a relative basis, NCB is also big, called market leadership. 38% of the banking market in Jamaica, 26% of the general insurance market in Trinidad and Tobago, and 39% of the life, health, and pensions market in Trinidad and Tobago, not to mention the market-leading positions we have in pensions in the Dutch Antilles. In addition to that, NCB is also diversified. Diversification reduces risk. And NCB's business lines are diversified across business segments from the long-term businesses like life insurance and pensions, which go on for decades. When you're doing something that's very long-term, the assets are long-term, the liabilities are long-term. On the shorter end of the continuum, you've got general insurance, which is more driven by episodic things like storms, like accidents. And then you've got banking, which can be transactional, like payment services, or it can be longer term, like wealth and asset management. So when you combine all of these together, you've got a diversified set of businesses where some businesses do better in one type of market and other businesses do better in another type of market, causing the business of NCB to be less volatile. And we're diversified geographically. On this chart, when you take a look at this, we're across 21 countries, but half of these countries are in what you would call globally investment grade countries. Jamaica would be just about the only country in which we're in that is not globally investment grade. We're also operating currencies that are either in US dollar hard currencies or currencies that are convertible into US dollars. And when you take a look at these countries, you'd also see that Trinidad and Tobago is an energy producing country, while Jamaica is an energy consuming country. And energy determines a lot about how an economy goes. So sometimes when oil is cheap, you'll see Jamaica will be doing better. When oil is more expensive, Trinidad and Tobago is doing better. But NCB is diversified across the markets. We keep talking about capital preservation, which is all around the concept of resilience. And so you can look at our track record. So saying we have these attributes, big, diversified, market leaders. But what does it mean? It means you can actually take a look at our track record. And just over the last 20 years, now NCB and Guardian actually go back almost 200 years each. But if you just look at the last 20 years, we've gone through a global financial crisis in 08-09. We've gone through 2 debt exchanges in Jamaica, and we've gone through a global pandemic at the start of this decade. And through all of that, you'll see that NCB has had virtually uninterrupted growth. We'd like to say, sometimes they just don't take our word for it. When we have all of those attributes, we have a lot of independent global recognition that attests to all the various attributes of which I spoke. We also have a very strong off-balance sheet assets under management business, and this adds to our diversification because in addition to having a diversified balance sheet, diversified geographically, diversified by business line, what a strong off-balance sheet assets under management business means is that the type of risk in our business is diversified. When you have on-balance sheet assets, you're much more focused on what happens when those assets go up or down, so goes the value of your business. When you have an off-balance sheet business tends to be more of a fee-generating business where you're paid for the value add, the services that you provide. And so again, it adds some diversification in our business. And we have a strong off-balance sheet business where our pensions business has been awarded top pension fund manager in the Caribbean for the last 9 consecutive years by World Finance UK. And that's because the performance has been great at 11.4% per annum as a 10-year average composite yield. What does 11.4% mean? 11.4% means that over 40 years, $1 million would grow to $75 million. Now, just to say, well, what happens when you do it at something that looks just like a slightly lower rate? What if you did it at 10.4%? That's only 1.1% lower. The difference after 40 years? Between 75 million and 52 million, $23 million difference between 11.4 and 10.4. And if you look at it over a bigger gap, the difference between 11.4% per annum and 5.4% per annum is the difference between having $75 million and having $8 million. And it's that 11.4% that NCB Pensions has as a 10-year average return that has caused them to be ranked number 1 for the last 9 years. 10 years, sorry. Continuing on this attribute of capital preservation, let me just talk a little bit about the leadership of NCB. So Michael Lee Chin is the chairman, and he's the epitome of what we think is very important in a business is that you would like your leadership to be owners, operators, and investors. Warren Buffett, probably the wealthiest one of the wealthiest people in the world and the most successful investor of all time, said that I'm a better business person because I'm an investor, and I'm a better investor because I'm a business person. Investors think about capital allocation and investment returns, the efficient use of capital. Operators think about how to manage operations for growth, manage the granular details of operating businesses day to day. And when you combine those 2 attributes, those 2 mindsets, you get great, well-run businesses. Michael Lee Chin would be the epitome of the owner, operator, and investor. My background starts, for those of you who don't know me, my background is varied, but I started in banking in 1998 by launching an electronic bank in Canada. And so I've been in banking for about 26 years now, but I've also managed a private equity fund and so served as and managed a publicly listed public mutual funds. So experience as an operator, investor, and an owner. Bruce Bowen is who you'll hear from later, was the CEO of and ran Scotiabank's operations in the Caribbean after operating and managing different parts of Scotiabank globally prior to that. And Bruce not only is a career banker, but Bruce is also an entrepreneur, an owner of businesses, and an operator within businesses. And Ian Chinapoo has been with CIBC First Caribbean, Unit Trust in Trinidad, which is an investment business, as well as with Massey Holdings, an industrial business. So again, you get that combination of being owner, operator, investor mindsets all in one person. NCB is rich in high quality management talent and deep, and that depth goes to our 5,600 employees across the Caribbean region that are the true strength of the group. We are, with all of that, with our size and our breadth, you can imagine we are a systemically important financial institution in most markets in which we operate. What does that mean? And again, thinking about this, looking at this through the lens of capital preservation, why is this relevant to me if I'm an investor and owner of NCB? It means we're more heavily regulated. We typically have to hold more capital than our competitors, and we have greater supervision. On the capital preservation side, I talked about our size, our diversification, our market leadership, the fact that we're heavily supervised, and the strength of our management teams. Now I'm going to flip the page and look at us from a growth perspective. From a growth perspective, and this is also leading into why it's an exciting opportunity to become an owner. About a year ago, about 9 months ago, we started what we now call NCB 2.0. Back in 2002, when Michael Leachin acquired NCB, NCB wasn't paying dividends. NCB had a lot of customer complaints, and NCB had a very high expense ratio. And what happened is we did very well for a number of years. And then after that, we had a little bit of a stumble. And in July of 2023, we found ourselves with the same three conditions: no dividends, high customer complaints, and a high expense ratio. So the beginning of NCB 2.0 begins with efficiency. We immediately slashed $8 billion of recurrent expenses. That's $50 million of annual recurring expenses we immediately slashed from the business. The second thing we did is we reallocated $15 billion. That's about $100 million. We reallocated that with the group to make our capital more efficient. So we had capital sitting in places where it wasn't doing very much for us. It's excess capital. We moved that up to the holding company and used that to commence debt reduction. On the governance side, we refreshed and reconfigured our boards of directors, and so therefore strengthened the governance within the organization so we have better oversight within the group, more checks and balances, and more diversity of thinking, as well as board members that are very up to date in their knowledge of banking, insurance, but also cybersecurity and the various other issues that are relevant today. We're instilling an ownership mindset through the entire organization that I distill down to a simple line that says, we'd like everybody to think about it from the perspective of do to others as you would have them do unto you. Because when you think about it from that perspective, you tend to think about what are the consequences to the customer of the actions that we take? What are the consequences to the shareholder of the actions that we take? What are the consequences to the country of the actions that we take? And that means do to others as you would have them do unto you. It's also like thinking of it like an owner, because an owner takes actions and owns the consequences. From a customer experience perspective, it's all about getting closer to the customer. We delayered management to get closer to the customer. We improved service. When you get closer to the customer, you learn very quickly what's bothering them. And the top two things that were bothering our customers on the banking side of NCB were ABM service levels and fraud. And we immediately took action. ABM service levels are now running during peak times at 97%, up from the 80s. And fraud incidents, after doing many things to affect that, are down about 70%. I talked about getting closer to the customer in NCB 2.0. Our chairman, leading by example, is taking management, taking the staff. We're going to the customers where they are. And as I mentioned before, through all the resilience of NCB is through all the ups and downs of global economy, global pandemic, global financial crisis, Jamaica debt exchanges, and through all of these various things, you would see that our operating income typically continuously grows, and over the last 5 years has grown at 11% per annum. We are also rated by global rating agencies, Fitch, S&P, AM Best on the insurance side, and regionally by Carey Chris. You'll notice on the Carey Chris side, we're rated with AAAs and AA+, which are about the highest ratings you can get. And so all of that foundation means we're poised for growth, and there's a rising tide happening in Jamaica. There's a rising tide happening in the Caribbean. You only have to drive around Jamaica, go around the Caribbean to see the growth. You'll see roads, you'll see wind farms, you'll see solar farms with solar panels. You'll see buildings, you'll see cranes in Kingston, you'll see factories coming up, you'll see all of that growth. And two things happen from that growth when you're a financial services industry. We're the mirror image of the real economy. On the one hand, we enable capital to flow into the businesses so they can create growth. On the other hand, when that growth takes place, it all needs financial services. You need insurance to protect your buildings. You need health insurance for your workers. You need payroll processing to pay all of those people. And when all of that happens, those people go out and spend money. And when they spend money, they spend it in merchants that need point-of-sale devices to process payment transactions. And then there's some savings, and that turns into investments. The investments turn into wealth creation, and the wealth creation enables us to invest it back in the economy. So the growing economies that we currently have form the first layer of the growth story going forward for NCB Financial Group. There was a reset to get our costs right, and then we have a growth story, one led by the growth in the region. Secondly, led by the fact that I talked earlier about, we have this broad and diverse product set ranging from banking to insurance, unique in the world, banking and insurance at scale. That means we are uniquely positioned to bring a one-stop shop, comprehensive financial solutions to customers, and in the process become their primary relationship, which allows us to generate more revenue per customer. And as we generate more revenue per customer, that is our second leg of growth. The third leg of growth is when we're doing all of that, we have the ability, because we've got a very strong pensions and wealth management capability, but we're underpenetrated, underrepresented in that category. And this is a category where the sky is the limit. There's no limit to how much wealth one can create. So the opportunity with growing economies and our wealth creation capabilities, we have the opportunity to grow our wealth management business, which will provide a third leg of growth for NCB. And what does all that mean when you put it together? It means that there should be substantial profit growth. Now I'm going to get a little mathematical on you here. When we talk about, we use jargon, we'll talk about an expense ratio, an efficiency ratio. We got as high as 82% expense ratio. Now in our industry, we should be about 60%. That would be kind of normal. 55 would be good. It's like a gold standard, getting closer to 50% as a very aspirational target. So going down from 80 to 60, what does that mean? Well, the other side of that is when you're spending $80 out of every $100 you earn, you've got $20 left over for profit. But if you can reduce your expense ratio to 60, it means out of every $100 you earn, you spend $60 and you've got $40 left over for profit. That's double the $20 you had before. So by just taking our expense ratio from 80 back down to 60, which is where it was before, we would double our profitability. And that resets our base. And then on top of that base, we would have those growth curves kicking in of growing economies, an increased cross-sell to be primary relationship, and a growing pensions and wealth management business. So when we combine those all together, what we get is rapid profit growth. As I mentioned, the reset took place last year started in July and took place through about September of 2023. And so when we start in our Q1 2024, which was in October of 2024, so October to December, in that first quarter, we generated $5.97 billion of net profit and $3 billion attributable to stockholders of the parent. and $1.32 of earnings per share. So we started our recovery then. For the first half of the year, for the half a year ending March 31st, 2024, what you'll notice on this chart is you'll notice that our cost to income ratio has improved. And it's improved a little bit, but most importantly, if you look in the middle of the page, what you'll see is our net profit went up from $4.6 billion to $8.7 billion in just one quarter. And so that means that we increased, in the half year. So we increased by 89% year over year, just by lowering our cost income ratio and with a little bit of top line revenue growth. And as I switch and you'll focus on the second quarter to the end of March 31st, 2024, at this point, this is a pretty clean quarter. This is our new normal. What you'll see is we grew year over year. We grew our revenue line by about 6%. So, okay. What you'll see is that our banking revenues were relatively flat because we're in a high interest environment, which is tough on the banking market. On the other hand, our insurance business grew by 18%, telling you about that diversification between insurance and banking. But we grew our overall revenues about 6%. But in the process, our cost to income ratio dropped to 66.28% from 75.6%. So our cost to income ratio dropped by about 9%, while our operating income was growing at about 6%. And the net effect of all of that is profits went up 74% to $5.6 billion in one quarter, or a run rate of about $22 billion per year, and an earnings per share of $2.36, or a run rate for an annual earnings per share approaching $10 per share. So I started off by saying three messages. NCB is a great investment, capital preservation and growth. NCB is a great way to own a piece of Jamaica. We're central to the economies of the region. The regions are growing. And so when they're growing, in some way, they will need something from NCB. And on the other side, NCB will basically be a beneficiary of all of that activity that comes out of that growth. So it's a symbiotic relationship. And we sometimes say, hey, if NCB catches a cold, Jamaica catches a cold. If Jamaica catches a cold, NCB catches a cold. Jamaica has a great outlook in front of it, and NCB is a great way to participate in that. Lastly, I mentioned it was about a unique opportunity, a unique time to buy in, to become an owner of NCB. Why? Because back in 2002, when those three conditions existed, when Michael Lee Chin bought in, no dividends, high expense ratio, customer complaints, the share price was around $3 a share, just over $3 a share. In 2019, the share price exceeded $200. It had gone up 60 times, and dividends had been paid out along the way. Over the next ensuing few years, we stumbled. And what happened? Top line revenue continued to grow. The gold line continued to grow. But dividends went down to zero. And when dividends went down to zero, the stock price followed it. And so by the time you got to July of 2023, we had a stock price in around $65. We weren't paying dividends. We had an expense ratio above 80%, and we had customer complaints about fraud, ABMs, and other things. The reset took place, and I just showed you the results where we're basically back and growing from here. And but the stock price hasn't returned. The stock price is still $65, 60, in that range, like it was back in July of last year. So it's a unique opportunity to actually buy in at a very attractive price. The APO price of $65 represents a price to book multiple of less than 1 times book value, which historically has been as high as 3.38 times. That difference is the value appreciation potential. Price is what you pay, value is what you get. The opportunity on NCB now is that because of the stumble, because of our weakness, but we've turned it around in NCB 2.0. The future looks exceptionally good. It's a great time to own a piece of NCB, to participate in the growth of Jamaica and at a price that, in our opinion, is highly, highly unlikely to ever come back again. And with that, I'll pass it over back to you, Ramon and Therese.
You really went through, you shared a lot. We need to ensure that we own a piece of Jamaica. It's the People's Bank, right? What you want to do is to ensure that, people understand that NCB is poised for growth, improving efficiency, improving governance, and improving the overall client experience, right? So those are some of the key things that we want to, make sure that we drill down into. We have been getting some questions, and ladies and gentlemen, please feel free to continue to share some of the questions that you may have in relation to the offer itself. So the first question that came in, and this is our safe space, Robert, Malcolm, and Bruce. One of the questions that came in, and we want to make sure that our investors understand what it is that they're getting into. First question: the price of the APO is currently trading below the APO price. Why should investors participate in the APO at this time? How did you come up with the APO price of $65 per share? I'm not sure who wants to take that one. Okay, Robert, go ahead.
Sure, I'll take that one. The $65 a share. So back to the idea of price is what you pay, value is what you get. If you take a look at the independent research, there are 6 to 8 independent brokers out there with research reports on us, and price targets intrinsic value of $75 to $80 per share, with a couple exceeding $80. So that's the value on the one side, not according to us, but according to independent brokers, independent researchers. So that's the value side. We obviously would think it's even better. You can take a look at the fundamentals. The $65 a share is around 1 times book value. And so by historical standards, that compares to a price to book of over 3 times. And you can take a look in the market and see what other institutions of our caliber trade. The stock market is a very thinly traded market. And so the question becomes is how many shares are available to buy on the stock market? There's also the question of when you buy in the stock market, there are trading commissions. And so the equivalent price, if you will, if you were to go and buy it on the stock market, is around $63.50. And then you add in brokerage commissions, you come out about even to the $65 per share that's in the APO. But it really comes down to the supply-demand dynamics, which is there's a very thin queue of shares that are available in the stock market, and so therefore it's not necessarily a very good. It's not a good indicator of necessarily value in the short term. But it's also, when you look at it from a supply-demand perspective, there's a very thin queue available, and therefore, if one wants to buy shares of any size, the APO would be the only way to do that. What I would suggest to you, Therese, and to the person with the question, is this. When you're making an investment decision, I think the first thing you need to do is decide that you want to own the business. I think it's a good business. It'll be around 20 years from now, and it's growing. It's a great business. I really want to own that business. The second thing is to say, how much of my net worth, how much of my wealth do I want invested in that business? And then once you know you want to own the business, and you know the size of it you want to own, then the third question is, at what price do I want to get in? What is my intrinsic value? I want to own this business as long as I can buy it at a price less than, and based on the research analyst reports, the independent reports that are out there, it would suggest at a price less than $75 to $80 would be a good price of entry. When I've answered those 3 questions, I want to own it, I want to own it in a certain size, and I want to buy it at less than, let's say, $75 a share. The last piece is, well, let me go out and start buying. And if I buy, I can buy on the market or I can buy in the APO, but I need to get out and start buying. Because the one thing I don't want to have happen to me is I don't want to be saying, I'm not sure whether I should buy on the market or buy in the APO, and then I don't do either. The APO ends and the stock market goes up beyond that price, and you end up missing the train as it leaves the station. So I would just caution people to be leery of that one very big possible mistake is while one's deliberating the question of do I buy at 63 in the market or do I buy at 65 in the APO, they actually miss the train.
So maybe I can come in here. Thanks, Rob. Of note, I think our research report in relation to the APO came out, I think, late last week. And we're one of those north of 80, Rob, re-intrinsic value. So it's a good point there, reprice versus value. The question that I have here, which I think complements the presentation that you gave, could you, Rob, or Bruce, or Malcolm, give us some insights into how the use of proceeds from the APO ties into the go-forward strategy that you highlighted for NCB 2.0?
Or maybe Bruce, do you want to take a stab at that?
Sure. I mean, the ability for us to realize value is, as Rob said, it's how we allocate capital and becoming more efficient. At the end of the day, NCBFG, we want to have obviously a stable equity base, but we also want to have flexibility so that if there's opportunities that one of our business lines have, the bank in Jamaica, our banking operations elsewhere, insurance in Trinidad and Tobago or elsewhere, that we're able to react and allocate capital, whether it's to take advantage of an organic or non-organic opportunity. So the proceeds of the APO are initially going to go to reduce debt levels at the FG, at the holding company level, so that we grow that flexibility. It's not the only thing we're doing. We, as Rob had indicated, we started off the year with some reallocation of capital so that we got more capital up at the holding company. And then just through profitability and our normal dividend ratios, we're continuing to accumulate capital at the holding company level. And that's really under the financial holding company legislation, both in Jamaica and in Trinidad and Tobago and throughout the region, is what you're trying to achieve. Make sure at the top of the house you have the flexibility so that you can react whether there's a need in one of the businesses or there's an opportunity somewhere. Ultimately, our big revenue opportunity, Rob talked about the expense opportunity, but the revenue opportunity is by us working more cohesively, both within the bank and between NCB, the bank in Jamaica and elsewhere, Guardian, the life insurance company in Trinidad, the Dutch Caribbean, and elsewhere, and just expanding the relationships we have with people. We want to be their primary financial institution and then sell more products, grow share of wallet to provide greater solutions to them, because that maximizes the profitability of those customer relationships. Right now, there are some differences between our footprint of banking and our footprint of insurance. In Jamaica, we have both, but in some other markets, we don't. So there will be opportunities there. We need to continue to strengthen our capital base at the holding group. We need to, and some of that, what do we do with that cash when it comes in the short run? We pay down debt so that when those opportunities come up to further enhance the revenue upside opportunities, we have that flexibility. So it's one part of an overall strategy to build strength and flexibility in our capital base at the holding company level.
Thanks, Bruce. So the other question, and I think, Rob, you touched a bit on this in your presentation, relates to the interest rate environment, right? I recall you speaking about the impact that higher interest rates would have had on the banking segment of the business and the fact that that would have inhibited year-over-year growth, right? Could you or any other member of the team speak to, I suppose, your present outlook with respect to interest rates and how you expect that to impact the business potentially in the near term, given what has happened in the recent past from an interest rate perspective?
So I'll ask Malcolm to think about being the economist prognosticator on the future. I try not to, so he can prepare for for predicting of interest rates. Why don't you, Malcolm, you want to take a stab at that, and then I'll add a little bit of color to it as well.
Yes, well, thanks. Well, I guess based on the signs and the projections, we would expect interest rates to be going down sometime soon, whether it's the Fed reducing or the Bank of Jamaica reducing. When you look at our income streams, though, when you look at our income statement, you're looking at net interest income, you're looking at fees and commissions, you're looking at other income in terms of gains, in terms of investment securities, FX trading, and you're looking at insurance. So the interest rate scenario, either way, whether it's high or it is low, I mean, as it gets lower, we would expect to be increasing our net interest margin, but we're very diversified in terms of our income streams. You would have seen our net interest income would have grown as well, and we're doing well in terms of insurance. Over the years, with the higher interest rate, the banking segment or the bank and investment segment would have still grown, but not at the same pace in terms of operating income. But under any conditions, whether it is high interest rates, lower interest rates, we are diversified enough to be able to still grow in different segments, while the other segment may be flat, as would have seen in terms of the banking and investment segment, where we grew by only 2%, while on the insurance side for the 6 months we're up more than 50%, and fee and commissions would have also increased. So we're well, I am not necessarily in the business of predicting the interest rate, but I'm sure Ramon and others who are experts, we would expect interest rates to be coming down sometime soon.
Yeah, if I just add, I think just to add on to that, about 4 of our 7 business segments experienced growth year over year, kind of again speaking to the diversification. And right now, the results we're achieving are with the kind of the investment banking, the trading side of the business, the capital market side of the business being subdued because of the tight liquidity and the high interest rate environment.
All right, so thank you for that, Robert. So the prospectus spoke to NCB Financial Group potentially paying out up to 50% of its ordinary realized net profit to investors, right, through dividends. What would you say is your long-term targeted dividend yield that you're aiming for as management?
So, I mean, dividend yield is hard to predict or set an expectation on, because it's also a function of the share price. So then we tend to talk about the things that we can control. So I'd suggest you to think about it this way: we should be an entity that earns 15 to 20% return on equity. And that in turn should mean that we're about let's say right now we should be around a $25 billion a year profit business, about $10 per share. With a 50% payout, that would be about $5 per share. We're not there yet. We're paying 50 cents per quarter. We've restored it. We've done it for 2 quarters, and the third one is just about to go out. So we're working our way back into that, but our target would be to get to a 50% payout ratio. We would expect to see those earnings grow year over year. But if you were to try and try and do the math on it, is you would take that says we should be about, and we're trending right now just under a $10 earnings per share run rate per year, and we want to get ourselves back to a position where whilst we're bolstering capital, paying down debt, funding growth, paying dividends, we're getting ourselves back to a position where we can actually pay out 50% of dividends, 50% of income in dividends. And that would mean on today's base, that would be somewhere around, $4 to $5 per share. And then you'd like to see that would mean that we're retaining enough money to continue to grow the business. We'd be retaining capital around 8%, and then we'd expect to grow at a higher pace than we retain capital. So we would expect to be growing. We'd look to grow at north of 10% per annum, and on top of that base of being paying out about $4 to $5 per share.
Okay.
Thanks for that, Rob. My other question relates to something else that you spoke to in your presentation, which I think makes NCB unique, certainly probably in the Caribbean context. That phenomenon of operating at both the shorter end of the curve in financial services and the longer end, right? You mentioned it, but could you speak to us a little bit about how that uniquely positions NCB to not only serve customers, but ultimately be a formidable financial services group?
I'm definitely going to call on Bruce to speak to this, because he's the one with the experience doing it, most experience. I should say we all have some, but Bruce has the most in this.
You're absolutely right that it's really unique, and it's part of the reason that in most large economies, you're not able to combine both one of the largest banks and one of the largest insurance companies in a market, is because it gives you just the ability to provide the complete range of financial services from the customer perspective. But as you say, you have both on balance sheet and off balance sheet, both the short end and the long end, which then helps on the investment banking side, because as we look for capital markets raising, for assisting clients and corporates across the region in structuring transactions, we have the largest pool of multiple currencies: US dollars, Jamaican dollars, Trinidad dollars, the Dutch Caribbean, Eastern Caribbean, the largest pool of short and long-term capital under management on our balance sheet and off balance sheet, which means as we gain the synergies of that business, we have an absolutely unparalleled ability to support government, institutional, corporate customers on the investment banking side and generate the type of returns that has earned us that leading pension fund performance across the Caribbean for the last nine years.
The final question from me, I'd say. The customer element has featured very prominently in your presentation, right? You spoke about delayering management and getting closer to the customer. I think you showed some graphical representations of that, right? You spoke as well about some of the feedback that you'd have gotten in terms of the customer complaints and where that turned. But could you talk to us a little, Bruce, maybe you, Rob, about some of the things that you think NCB has been doing well based on the feedback that you've gotten from your customers, and how you expect NCB 2.0 to build on that going forward to create value, not only for your customers, but ultimately, obviously, for the stakeholders, shareholders who would be interested having potentially participated in this offer.
Sure. And if I go back before Rob and I got involved, Rob got more involved in the business. I believe NCB Financial Group has done a great job of developing the broadest product range in Jamaica of any financial institution. and across the Caribbean, supplementing a very strong insurance offering, life and general insurance and pension fund management from Guardian, with select banking operations, largely on the investment banking and capital markets across the region. In delivering to the customers in Jamaica, we've done an amazing job on the payment side. We offer payment solutions that no one else can. We're, about 60% of the merchant acquisition market. We're well over 50% of credit cards in the market. So an awful lot on the payment side. We've been a digital leader in some of our functionality on our, particularly on our retail and consumer product offering. What I believe we did, and it's always dangerous for people to, as you comment on before you got involved, for people to take it the wrong way. But I think in our drive to be the absolute digital leader, we lost, and maybe coming through COVID a bit, we lost touch with the fact that while yes, as the leading bank, we have to be the digital leader, we're not a niche player. And there's a lot of Jamaica that is at different levels in that digital adoption journey. Over the week of Christmas, and we have the largest ABM network, our ABMs alone dispensed $10.2 billion of cash. That's about $3,500 for every man, woman, and child in Jamaica. That isn't indicative of an economy and a customer base that's ready to go digital alone. So what we've really tried to do is listen to our customers, and we've been in the press a lot. You've seen the pictures of Michael E. Chin and so many of our team out with customers. We're doing town halls, we're doing lunches with customers, and just getting out on the branch floor and talking to customers with management and executive at different levels, listening to what the issues are. These aren't issues that can always be addressed overnight, but understanding what they are and listening. It's so easy in banking anywhere, and particularly when you're a large bank. As the leadership of it, it's easy to lose touch with the average person that you're servicing. It sometimes can go to your head. And it's important, and what I really admire amongst NCBFG 2.0 team, Michael E. Chin, Rob, Ian Chinapu, myself, and the rest of the executive teams, as we're all hands-on people and get out and talk to people and listen to what they're saying and not try to overcomplicate it, but address the issues. And that's why we focused very much on, let's get the ABMs working. Let's get fraud dealt with. Let's start reducing the length of time when someone calls in with an issue to our customer care unit to get a response back out to them. Let's really try and get the turnaround time on loan applications down, especially on the commercial side. And there's a lot of these things which, and we see them as well on the insurance side, the claims processing times and all of those. Those are the types of things that solidify customer relationships. Those are the types of things that give you, the love that a customer will, put up with certain things because they know that you're listening to them and trying to address them. We're in an enviable position. We talk about being Jamaica's bank. There's almost no one in Jamaica that isn't touched by NCB, because even if you say, well, but I'm not an account, but maybe, and some people have a credit card, or if, maybe your pension in the company you work for is being managed by either NCB pension or Guardian pension, or you're getting your car insurance or home insurance. If nothing else, you're going and you're using your debit card at machines that are NCB machines. That gives us an enviable position that we touch almost everyone. So if we can listen, understand what people are looking for, if we can deliver on the product consistency, if we can get our customer experience right, this is going to sound a little presumptuous, but if we are executing well with the broadest customer range, the biggest bank, the biggest distribution network, providing great service, there is no reason for anyone to deal with any other financial institution in Jamaica. And if we can build the capital flexibility at the group so that we can replicate that combination of strong insurance, strong long end of the market banking, broad payment services across multiple markets in the Caribbean, it's a combination that as Rob started his presentation, what builds long-term wealth? You don't build long-term wealth buying a stock for $63.50 and selling it the next day for $65. You build long-term wealth by building a business today at a price to book ratio of 1 that has opportunity to leverage all of those strengths, see revenue grow faster than market because of those opportunities to leverage the scale on cross-selling, that has the ability to see expenses grow slower than the market by leveraging the scale to be the most efficient operator in the market, of investing in that type of business, duplicating the experience of those investors that bought in at about $3 in 2002 and got it up to $200. So, that's focusing it, and it means we need to focus on customers.
So focus on customers, improving the overall efficiency. That is what NCB Financial Group is about, ensuring that every aspect of the business is focusing on that overall customer experience. So thank you for that, Bruce. We have another question here online. The question is, does NCB Financial Group have any plans to cross-list on the New York Stock Exchange, and for that matter, any other stock exchange globally?
No,
that's a Rob question.
No current plans for that. That's always a possibility, but at the current time, that wouldn't be on our radar. Right now, just to pick up on what Bruce was saying, for Ramon, you actually asked, what do we do well? Over the last number of years, there's been an incredible platform built. The breadth that we talk about, geographic, product suites, all of that has been built so that we're big and we're broad. When we're big and we're broad, and the reason you hear us talk about so much about customer experience is the double-edged sword of it. We're so big that we need to make sure we're highly efficient, because we have to make sure that we're brilliant at the basics, that we don't make mistakes, because mistakes become very expensive when you're big. Malcolm will tell us the problem is a little mistake multiplies a lot when you're big. And the second thing is you have contagion risk. When our ABMs aren't working, people have concerns about other parts of our business. They may not buy our insurance because they are unhappy with our ABM network. And so there's a contagion risk. So it becomes really important. So we do a lot of things exceptionally well every single day. Because we're big and we're broad, we actually have to be, and we are, as you're recognizing with us, we're just talking about the tip of the iceberg, which is the things that don't work very well. Because when we're big and we're broad, those things, it becomes really important that we make less mistakes, that we do what we do exceptionally well. So we're very focused on brilliant at the basics. We're obsessed with the things that are not working well, because there's actually a whole lot that goes very, very well and everybody takes for granted. The billions of dollars of cash, the ATM network that represents about 40% of the Jamaican ABM network in the country, the point of sale device network that represents about 60% of the point of sale device network in the country. All of that stuff works every day. It's just that's not good enough if you're us, because when you're big and you're broad, it's doubly important to make sure that it's next to perfect.
Okay. All right, so thank you for that. So we have, one final question here. And the question is, there are other offers out there in the market right now. And, this gives you an opportunity to, really and truly, let investors know, why NCB Financial Group now. There are other offers out there. Why invest in NCB Financial Group's APO?
Yeah, I'll start. So the number one reason is it's the business that has enduring growth and capital preservation. Back to those the conditions I said. You want a business that you know is going to be around 20 years later. Ask yourself the question: how confident am I that that industry, that business will be around 20 years from now? That it will grow over the next 20 years, that it's actually coming, it has all the attributes that are necessary for growth that we've talked about. And then lastly, what makes it the right time? We were over $200 a share. We're down at $65 a share. It's a great opportunity to buy in at a discount, and you don't have to take our word for it. You just have to look at the independent price targets that are out there, and you'll know that it's an opportunity to buy in at a discount. Price is what you get. Price is what you pay. Value is what you get. This is about as good a time, well, a better time than any to own a piece of the growth that is taking place in Jamaica and in the Caribbean. And I can't think of another company that is as central to the economies of Jamaica and the region that you can sit there and say, oh, I think if I just bought 100 shares of it, I'd be participating in that entire growth machine that is out there, that entire train that is taking off. There is no other company in Jamaica or in the region that is as central and effectively gives you participation in buying a piece of the growth that is taking place in the region. And the last thing you want to do is to know that everything around you goes up and you don't. That's the worst thing that can happen. So the tide is rising. Jamaica NCB is the best way to participate in that rising tide.
All right. All right. So thank you for that, Robert. There you have it, ladies and gentlemen. Why invest in NCB? This evening, you got an opportunity to hear from the executives themselves about the offer. You got to hear why it is that you should own a piece of Jamaica, the People's Bank. You got an opportunity to understand the importance that has been placed on efficiency, governance, and client experience. And that is what you're going to get when you invest in the NCB Financial Group APO. Ladies and gentlemen, on behalf of Barita Investments Limited and NCB Financial Group, we'd like to thank you for your time. We look forward to hearing from you. Barita is your selling agent. Please feel free to reach out to your financial advisor if you have any further questions in relation to the offer. Thank you.